Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hello everyone, this is Ask Rob and Rob, the show where you get your questions in. Sometimes property related, sometimes a little bit different, but we like those questions too. And it's really simple to get on the show. So let's give you a quick reminder of that process.
It's so simple. All you've got to do is call 013 808 00035, or alternatively, you can go to propertyhub.net/ask. But this week we're restricting ourselves to just one question because we've got plenty more to go at, but this is a big one and there's plenty to say. So let's have a listen to it now.
Hi, Rob and Rob. It's James here. I know everybody says it, but thank you so much for a fantastic podcast. I think you do property investors everywhere a great service. So thank you very much. My question is partly around the pandemic and the increased public spending that we've seen in the past 18 months, much higher than many years before it, and also how it ties into the property cycle that obviously you've enlightened many people about. And I just wondered, I get the impression that we're heading towards a period of increased inflation rates and higher taxes as the government tries to balance their books. And does this affect the strategy that we should take with property investments to make sure that we can afford them? Should we maybe limit how much leveraging we're doing on investments so that we don't risk overexposure if the affordability becomes more difficult in the future? Should we look at fixed term mortgages, or is it a time of opportunity where we should double down because property prices are only going to increase and potentially now they're going to increase even faster? I hope that makes sense, and thank you very much.
Well, it's really interesting, James, because actually you could say, well, this is exactly what the 18-year property cycle predicted, that towards the latter part of the cycle, you go into a boom phase, and that boom phase has just started. And according to the 18-year property cycle, during the wobble, lots of stimulus is put in place, which then really overcharges and stimulates the market into a boom phase. And we've had that. We've had QE. And all that investment, all that money supply, all that stimulus, if you like, has helped an increase in property prices and an also increase in rents and an increase in many other asset classes. What's happened is we've had massive inflation. And the reason we've had massive inflation is because we've had a massive increase in money supply. So you shouldn't be surprised at what you see and question the 18-year property cycle, although you're welcome to question it because it allows us to discuss it and help a lot of people. But actually, it's playing out as you would expect. So if you buy into the 18-year property cycle, and remember, it's not a cast iron guarantee, it's just the tool that we use to make predictions and our own investments ultimately, then you'll know that the phase that we're in is the beginning of the boom phase, where there's a lot more to come, a lot more of growth to play out. And therefore, Rob, it might be a little premature to start positioning your portfolio, preparing for a crash, or just affordability being stretched or interest rates increasing dramatically, because although it feels like a roller coaster at the moment, it has only just begun.
Well, that's it. I mean, when you look forward to the crash, I don't mean look forward to, but when you look ahead to the crash, then the key there is that you're positioned so you're not in a position where you're forced to sell. That is the real key to the whole thing. If you're smart enough that you can sell at exactly the right time, then wait for the market to crash and then buy again at the bottom, then well done to you. But most of us are not capable of that. Or what you really want to avoid is being a forced seller. So that is about making sure that you've got strong cash flow and that your leverage isn't off the charts and all the rest of it. And we've talked about that on the podcast before. But how cautious you want to be to make sure that you're safely positioned for that is a personal decision. And if we're right about the timing of the cycle, then there is time to position yourself for that. But what should you be doing ahead of that? Well, you mentioned fixed term mortgages. And personally, I would be fixing my mortgages for as long as I could, unless I wanted to take more money out of my portfolio or was planning to sell a property, because it's hard to see how rates could get much cheaper. And having them fixed for a long period of time gives you predictability and safety. So that's one thing that I'd be doing. You also talked about the higher taxes. That's possible, but higher taxes are always possible, and you can't really use it as a reason not to invest, because otherwise you would just never invest, because there's always a possibility that taxes are going to go up. And if taxes do increase, and capital gains tax is a tax increase that's been talked about repeatedly but hasn't happened, and again people were talking about it happening in the budget this month and it didn't, then well, you only pay it when you've made a gain. So that's not the end of the world. You also mentioned a period of increased inflation, which is possible, but if that is the case, then that helps you as a property investor, because it means that it's going to lift the value of your property and it's going to erode the real value of your debt. So I see there's been two parts to this. How do you want to position yourself to take advantage of the growth that is yet to come? And how do you want to position yourself when inevitably a crash comes at some point in the future? You can go aggressive to grow your wealth by as much as you possibly can in the boom phase, or you can be a bit more cautious. And when it comes to the crash, it's the same again. You can position yourself ultra cautiously to make sure that you could survive the absolute apocalypse, or you could take a bit more of a moderate view. It's completely personal choices. But as Rob said, so far, the cycle seems to be playing out. So there's nothing in there that should make you rethink your strategy because nothing's really changed. But you do need to have a strategy around those two events. And hopefully that's given you some factors to be thinking about.
And of course, remember, we've done plenty on the 18-year property cycle previously. If you search on propertyhub.net in the podcast section, 18-year property cycle, there's a little search bar there. You can listen to all the episodes on that subject. And there's a free course on the Property Hub website as well that you can access. So make sure you check that out. And make sure you join us on Thursday for the Property Podcast, because of course we'll be back then. And we'll be back next Tuesday with Ask Rob and Rob. So until then, take care. Have fun. Bye-bye.
Bye-bye.